Hi, you're watching Investor Insights, and in this video I'm going to be discussing managed funds. This comprises everything from just mutual funds, super funds, hedge funds, managed currency funds, anything that is a managed investment. This video is going to look at more or less the cons of being involved with them. There are pros, but they're far and few between. The first consideration that you must have before you invest into any managed investment is the management itself. You've got to look at the track record of this management. You've got to look at what it's investing in. You've got to look at what this management team has a view on the immediate, long-term, intermediate future. What differentiates one fund from another is the management. Now, other considerations to make before you invest in managed investments are the costs. Now, I'm not saying that managed funds are a bad thing. I'm just saying that you can do better yourself. You can always do better through self-education, self-awareness, and tactical entry, exit points, realizing good profits, and not paying people to do it. There is no greater satisfaction than making money for yourself, not relying on other people's research or lemming investor methodology. It's just a waste of time. Now, a managed investment more or less is going to cost you money, and some funds will cost you a hell of a lot more than others. So the simplest fund would just be a low cost, nil entry, nil exit index fund, like something from the Vanguard Group or something along those lines, where instead of being stock specific, they just buy across the whole index itself. So if you put 100 grand when the index is say the S&P is at 1500 and it goes to 1650, so there's a 10% rise in the index, basically your portfolio is going to be up 10%. It tracks it very, very closely. You've got low cost entry, sometimes no cost entry, low exit, small management super funds, which are like your industry super funds. And then you've got things like high entry cost, high management cost boutique hedge funds, which are basically the old adage is 2 and 20. So 2% in, but 20% management fee. So on 100 grand that you invest with them, 2 grand gets jacked before the money has even hit the account, and every year they're going to charge you 20% of your portfolio to look after your money. And if you were given the option, man, you wouldn't go anywhere near them unless those guys could provide you with, a 25% return. So you, in fact, only bank 5%. It sounds ludicrous, but it's rife out there. You just have to learn to read the fine print. Now, let me give you an insight into the mentality of why people should not invest in these managed investments. If you were to invest 100 grand into any asset class, whether it be stocks or a house or bonds, whatever, don't you wish to know what your 100 grand is buying? Does your 100 grand buy you X amount of BHP? Does it buy you X amount of Intel or X amount of Netflix? Here's a tip: bad investment. If you're spending 100 grand on a property, you'd like to know if it's, 1 bedroom, 2 bedroom, whatever. If you were to buy in bonds, you'd like to know, what rating is the bond, what company it's from, and what the yield is. The list goes on. When was the last time you put 100 grand down on something and you didn't have a clue what on earth you were getting back for it? And the answer is going to be not a chance in hell. But yet, you do that when you buy into a managed fund. You put 100 grand into a managed fund and you have no idea what your 100 grand buys you. Sure, you can go online, you can read the prospectus. They'll say, we're going to allocate 10% to the resource sector and 15% to the finance sector, whatever. They might even list their top 10 shareholding. 10% BHP, 12% CommBank, whatever. But what if you wanted to know exactly what your 100 grand was buying? And the answer is, you're never going to know. You can find out how many units of the fund you're buying using the 100 grand, but a unit of something that you don't know what it's comprised of doesn't mean anything. This is where you taking control and you doing the investing or direct trading is going to give you the most satisfaction, because and control, of course, because you know exactly what you're buying, when you're buying it, when you're selling it. These managed investments don't tell when they're selling down something or buying up something. They haven't got a clue. I mean, these are the same. These investment managers are the same fools that were selling Telstra when it was at $250 odd. That are the same people that are buying it at $5.10. Now, the only way to make money is to buy low and sell high, or when you're shorting, to sell high and buy back low. But the thought is exactly the same. The process is exactly the same. You buy something cheap and you sell it at a higher price. That's how you make capital gains. These fools are buying Telstra at $5.10. But 3 years ago, these were the same fools selling it at $2.50. Now their mantra is, let's chase, let's be lemmings. When everybody's selling, we're going to sell. But yet when everybody's buying up high, we're going to buy high too. Now if you bought something at $5.10 and you sold it at $2.50, how on earth are you going to make a living out of that? But yet, these are the same imbeciles that are doing it for you day in, day out. They're chasing the market. What everybody's doing, they're doing. QBE, 2.5 years ago, went from 14 down to below 10. Now, these guys were the people who were buying it at 14, and they were the same guys selling it below 10. Again, another example of a bunch of lemmings following each other to their demise. I do not recommend a savvy investor into putting their money into a managed fund or a managed investment. Educate yourself, learn to understand the principles of investing and trading, and control things by yourself, for yourself. Don't waste your time. The other consideration that I have to provide is, if you do not have the time to educate yourself and you don't really care and you just feel that you have to do something, by all means, get yourself into a low cost, low entry, low exit, low management index fund. You can't really go wrong unless the market implodes. But the most important thing is, I think if you can't be bothered educating yourself, take your money, stick it in the bank, let inflation erode it away, but at least that's not going to be as bad as the fund managers losing it for you, or you making a bad trading or investment decision and you losing it yourself. So if you haven't got a clue, just stay out. As I always say, if in doubt, stay out. But to me, managed funds, they're not the way to go. Until next time, happy trading.